You're listening to the Practical Wealth Show with Curtis May, putting you in the driver's seat to control your finances. Let's start the Practical Wealth Talk about alternatives to Wall Street.
All right. Hello, everybody. Welcome back to another episode of the Practical Wealth Show. And I am very excited to title this show. Let me get started. I'm very excited to have Jim Small here, the managing partner of Sante Realty out of, I think you're in Scottsdale, right?
Yeah, Arizona.
Right? Yep, Scottsdale, Arizona. And so Jim, so the title of this episode, as we get into it, is I've titled it the Building Your Perpetual Passive Income Machine, right? And kind of stole that from your book, Jim. And so what we're going to talk about, we have a really exciting talk. I want to share a little bit about his background, how he built his business, and what he's out there, how he's helping clients build wealth, which I think is absolutely brilliant. So Jim, welcome to the call.
Thank you. Thanks for having me.
Yep, my pleasure. And so as we get started, tell them, I'll tell them a little story about how we met, but tell them a little bit about the short version of your background, and we'll kind of go from there.
Sure. You want me to talk about the company's background or my personal background?
Personal to the company.
All right. Sounds good. Well,
like how you got into real estate. Yeah.
Yeah. I think like a lot of people in real estate, I was introduced to it through Rich Dad, Poor Dad, and reading that book.
A theme there.
Yeah,
right?
Exactly. Right. I was reading that book on weekends and nights while I was actually doing corporate consulting. And then I started reading more books about weekend landlord and how to fix and flip houses and all kinds of things. And when I went to business school to get my MBA, I had really focused at that point in the program on how to get skills to create a real estate investment company. And so, unfortunately, when I left graduate school with my MBA, I didn't have any capital, and I didn't have really good credit, but I did have a lot of student loan debt. So I started out in property management to be able to pay off those student loans and feed my family. So for almost 10 years, I ran a property management company, mostly in the residential space, and we ended up expanding that. We made a lot of mistakes along the way, but we ended up eventually selling it for a nice amount of money, which gave me some capital to buy real estate. And we started buying 10-unit apartments and then 20 units and 30 units. And our largest so far to date is buying 300 units in one property with investors and sharing that cash flow and profits with them. And we're just having a great time doing it.
Wow, that's awesome. That is fantastic. So now, why do you because I know you have very specific feelings on this. Do you like real estate as your preferred asset class of the different ways that people invest out there?
Why do we prefer it? Why do I prefer it?
Yes. Why do you? Yes.
Yeah. I mean, I think there's just a lot of advantages that if you look at the tax code, if you look at the banking system, if you look at a lot of factors like other people paying your mortgage to make you wealthier, there's a lot of great things. So for example, in real estate as an asset class. So to elaborate on those just briefly, unlike other asset classes, you can use other people's money in the form of leverage of mortgages to pay for 80% or more of the property that you're buying, even though you get 100% of the benefits. You as the equity participant, you as the person taking over the deal, only have 20% of the capital in it. And so that leverage is fantastic. And then at the same time, under the tax code in a lot of jurisdictions, but primarily we're familiar with the ones in the United States, you get to take phantom deductions in the form of depreciation, which essentially lowers your taxes, and you get to even write off the interest you pay on that leverage we just talked about. So the government has set up and the banking system has set up a lot of benefits for people to buy and own and then rent out real estate. And the last piece is the rent out part. You've got people that if we take care of our properties and our residents, they pay down our mortgage over years in the form of their rent that comes in. and we end up with the equity, even though they paid down the mortgage. And so there's just a lot of constructs that make real estate an extremely attractive asset class for really anyone, in my opinion, but certainly we love it more than others.
Okay. Yes, that makes sense. And I agree with that. And I wanted to get that out there, in terms of why, because I've seen you on a video where you talked about that. And, because I come from a background where my first 15 years of my career, I thought, equity mutual funds were the end all be all. And then when I read Rich Dad Poor Dad, I was like, wait, what he's saying and, what my wholesalers are saying aren't the same thing. you know,
No.
and then I heard one of his tapes. I heard Kim Butler, and she said something that just put a crack in my whole belief system. It took me a little while to figure it out, but that kind of transition to me to where I am, teaching infinite banking, on the alternative investment space. But so just a little quick background, a quick aside. That's where Jim and I met at the first Prosperity Summit for Advisors. What was it, 3 years ago now? Because it's in Scottsdale, and you were a guest,
Yeah, I was. You're right.
right? Right. And when he was hanging out at the first. We have like a get to know you buffet, so we ended up talking most of the night, and he was just, like, well, I'm not quite sure what's going on here, but and we talked about everything but money, well, like under the sun, about sports, about this, about that, and it was so funny. So so now he's been to, and then nobody really knew what he does, and then the second year you did your talk on the 10-30 plan, right?
Yeah, Kim
Talk about
invited
that.
us to share that with everybody there, and we really enjoyed it.
Yeah, the 10-30 plan, and it was, and so it was like, wow, what the heck is this? This was the most awesome, just system of because what happens is he broke us down into a system. Part of what I want you to hear as we talk about this is that for some of you, 'cause I got clients, I got listeners that are that flip and fix and flip, and they're buying real estate, but they don't really have a process that they adhere to, you know. And I think that you can learn that no matter what you're doing. I saw some stuff that I could add to my business as I was rereading your book today. And so, talk about your if you would mind sharing a little bit about how you broke your process down into 4 steps, right? What I call your money rules. How you develop those, and then how does that guide your business and your investing?
Yeah. So the spoiler alert and the punchline, if you will, is that we're doing exactly as you said, Curtis. Is we developed a 10-30 plan, which essentially is a target to get everybody at least a 10% yield on their real estate investments per year, and make sure everyone who invests in real estate in our methodology gets paid every 30 days. So at least 10% yield per year and get paid every 30 days. So that's really where the process came from, because that's the goal. And so process to get there, like you said, is we started doing this with single family houses, and then my wife and I started doing that, and then really grew into the multifamily space we do now. And so the way that works in the sequence, and we always follow the same process, because once you got a proven process, you can get a proven result. And so our first step is what we call the Sante acquisition advantage. And the advantage of that step is that we can source through relationships and contacts that we have uh, deals that other people can't get. And so we have developed those relationships over many years, just like all of us in life develop relationships with friends and coworkers and those things. We've developed relationships with people that bring us multifamily apartments to buy that other people don't know about. And so because we get those proprietary opportunities through the Sante acquisition advantage, then we can go through a very detailed process called the Sante due diligence discovery. Now, the due diligence discovery is kind of the most onerous way of analyzing real estate, not only the piece of real estate itself, but the area of town it's in, what town it's in a larger context, and then what's the competitive landscape, what's the environmental situation, all kinds of things that we look at, to the point where really over time, only 1 out of every 100 properties that we put into the Sante due diligence discovery actually pass all of those steps and get taken out to be purchased by us with our investment partners. And so if we get that one out, that one gem out of 100, then we go into a process that's called the Sante Renovation Refresher. And this may be a little bit newer than the version you saw, Curtis, because what we realized is we buy these properties, but a lot of them need renovation to maximize the rents we're going to get from our residents. And so we'll go in and do new flooring, we'll do new fixtures, we'll do new faucets, kitchen cabinets, handles. Sometimes we're putting in dog parks or washers and dryers in the units, all kinds of things to refresh that property so we can maximize the income. And really where the rubber hits the road for us is once we do that Sante renovation refresher, we then asset manage that in the Sante asset management method. Our method is to manage an asset as if we're never going to sell it. So we'll actually manage that, whether it's the roofs or the furnaces or the parking lot, as if we're going to keep it forever. And that keeps it in tip-top shape and it nice for the residents and a great asset for us and our investors. And at the end of the day, it goes back to that 1030 plan. The very last step is the Sante Investor Cash Flow Maximizer, where we're literally maximizing the cash flow to our investors to achieve that 1030 plan with every property we buy.
Wow. Yeah, that's it. And so, two things I want you to get from this, because there is an opportunity to partner with them that we'll talk about later. But, for y'all that are investing, could you state your plan that succinctly, right? And so I just want you to think about that. So I already got half a page of notes. I just want you to know, so when you listen to my shows, you better get somewhere. You listen to it once while you're at the gym, then you need to get somewhere with a notepad, right? And take some notes. So that was really good. Now you said something I wanted to bring out, because this is a major portion in your book, and you talk about this, and you said something about yield, 10% yield. And so I want you to talk about yield versus return,
Sure.
and how you minimize risk. So, well, that's two questions, but yield versus return. Let's talk about that for a second.
Yeah, I mean, return is what people are used to hearing, and that's how third-party reporters like Morningstar reports on mutual funds and stocks and bonds. And, I got an MBA, as I said earlier. And after I got my MBA and I was managing our property management company, my wife and I were investing, a little bit of leftover money we had at the end of the month in a 401k kind of structure. And we kept being told that we were getting this good average return, and our account wasn't going up. Our brokerage account sometimes would even go down. And our report kept saying we have this really positive average return. And I just couldn't understand it. And so one day it dawned on me to go calculate it. And what I found was the way they calculate return is not the same as I perceived it. And so, for example, it's be a little bit tricky to do verbally, but let me try. In the case of our account, we had an account where, let's just say the balance was 100 when we started. It would go up and down, right, like stock markets do. And so we would go down. Let me just do it this way. We would go up 10% the first year, and we go down 20%. And then we would do nothing the third year. So just think about that. The 100 goes up to 110, but then it goes down 20%. So it goes down 20% on 110. I think that's 22. So that goes all the way down. What's that, Curtis? Help me out. 88?
Hold on. Yeah, I'm trying to pull
98.
up my calculator real quick.
I'm gonna try. I told you doing this on the fly is tough, right? But it goes down 22. And so I think that's 88. So it goes down from the 110 to 88, and the next year it does 0. And so now what's your account balance? It started at 100, now it's 88. And remember, it went up 10% first year, down 20% the second year, and 0 the third year. And what that would show is, in this example, it would say the average over that period of time was down less than 10%. but I'm down 12%. And I just said, this doesn't make any sense. The math and what you say aren't the same. And what I found out in my mind, I was actually trying to figure out yield, not return. So yield is different because yield is what you actually get. And so most people aren't used to asking what's the yield on that investment. We've been trained and taught by Wall Street and the marketing firms behind Wall Street to ask about return because you can manipulate that in simple math and it's not the same as yield. But everybody I know can only spend actual yield. Return doesn't matter. And so we talk more about that in our book of multiple examples. And again, it's hard to do verbally on the fly, but yield and return are not synonymous. And you can just Google it to find it out on your own as well. But you do not want to be looking for return in investments. You want to be looking at yield.
Right. What you end up with, because we say math is not money, right? And so, most of the perspectives are very disingenuous because, if I tell people, look, if you've got $1,000 and your account drops to $500 or 10,000, it drops to five, that fund manager has to earn 100% just for you to get even, right? You haven't made any money. I mean, if you make, well, what if you make 50? Oh, you got to make 50%. No, that only brings you from 50 back to 75, right? And so we're not even counting taxes or fees, right? And so, but they could show it a perspective that, well, we did 12%. Well, they did, but you didn't. So your money is, most people look at their 401k and they think, oh, well, it's up. Well, because they heard all this stuff on TV. But if you really look at it, it's up because you're putting new money in every month. And so what happens is when you're talking about yield, if somebody puts a 100,000 into what you're talking about, what you're saying is at 12 months they've gotten 10% on that, or $10,000. That's yield. What you get to
Yield is
spend.
$10,000 on the 100,000. Correct. That's a 10% yield.
Right. And so that is a critical point. And so beginning to, even as when I talk to real estate investors, they don't like, sometimes they're like, all right, well, I can get this for this price and I can sell it and get this price. So I argue, say, look, you're not really investing, you're speculating, okay, because there's no cash flow. But, even stuff like, well, what's the, cash on cash return? Like just really understanding the numbers so that you can, take a professional approach to investing is what I'm finding a lot of new people don't know how to do. They're not really, it's like they're still not really investing with the numbers, like with their calculators and with pen and paper to see if it's even worth you. Or I think what's really important of what you said of the 4-step process is the due diligence. I don't think a lot of times people don't really do the due diligence. I just had a client that wasn't even a client, it was somebody that was referred to me, and they had a property got for like $5,000, but they didn't do the. So I said, well, I'll shoot you to a hard money lender. They wanted to see title stuff, and they weren't confident with it because they thought, well, she was told she could get 200,000 for it, so she didn't do a title search. So now it turns out there's like 35,000 in back taxes, right? And the property probably needs $100,000 worth of work. And I told her, I said, like, if you got it for five, I said, well, what's it worth when it's done? Oh, about 250. I said, well, what do you got to put into it to get it done? Oh, about 100. You think you get 100? What do you think you get for it now? 120. I said, well, sell it now because you don't even know how to do this. So you don't know. She'd never done a deal before, and I said, listen, why don't you just sell it to some other investor that knows how to do this stuff and live to fight another day and go take your profits and take a course or something, and put some money in the bank. So that is fantastic. So what was another question I had for you? Oh, it just left me. Talk about the concept of the perpetual passive income machine. Like you talked about the what you're trying to create for your investing partners and how that works, as much as that you want to share.
Yeah. So essentially and we wrote a book on this called The Perpetual Passive Income Machine. and it really is just our philosophy on how anyone should be buying any real estate. So when my friends say, Jim, I want to start being in real estate. I don't necessarily want to invest with you guys in multifamily, but I want to buy my own real estate. How should I do it? This book explains our philosophy on the way to get perpetual income from real estate and to grow that portfolio. So in a nutshell, what it says is you buy a property with leverage. So you're using other people's money, as we talked about earlier. And then after a few years, let's say 3 or 4 years, you basically refinance that or take out more debt to get your original capital back, and you buy a second property. And 3 or 4 years goes by and you do that again, and you end up continuing to buy more property essentially with the same initial investment. And what happens is over time, you've got tenants or residents paying down your mortgages as you're using the bank's money to continually grow your portfolio of cash flow. And so a real quick example is if you buy something for 100,000, and most houses, if you're going to start with a single family house, you probably get 90% financing from a bank. And so you only put 10,000 into a $100,000 house. Well, as that house goes from 100,000 value to 103 and then 106 and 112, in the third or fourth year, the bank will look at that $112,000 valued house and say, it's valued at 112. You only owe 90. I'll give you another 10 of the loan. And lo and behold, that was the first 10 you put in. So you take that 10 grand and you go put it down on a second house worth 100,000, and you do that again. Well, you still own the first house. It's still paying you profits. You're paying a little bit more in mortgage payments, but it's still paying you net profits. And now the second house is doing the same. And then you can do it again in a few years, and the third house is doing the same. We think it really takes about 10 houses in that model for you to be permanently retired. No matter who you are, no matter where you live, if you do that 10 times on a very, very small scale, you can have permanent income and never have to work again in your life.
Wow. So that could be 2 houses a year for the next 5 years or one house a year for the next 10 years, and you could conceivably get yourself out the rat race.
Exactly. And you can do it as fast or as slow as you want. And some people only want to buy when the market's down, and so they're getting a steal on a house, and that's great. Some people, as long as the math works on cash flow day one, they'll buy at any time. So to your point, Curtis, people can do it quickly or they can do it slowly, but the math still works. It's just straightforward math.
Yeah, that's all I see, because I try to share with people. I've been kind of coined the phrase. I want to help people build what I call a see. Now I get on a call. I forget what I want to say. The asset based, or not asset based lend. Asset based. I called it. What did I call it? Oh man, it'll come back to me. I'll put it in the show notes because I can't right now. It was called a tangible asset portfolio, right? Of Yeah, of you, with all, let's say if you like the real estate as an asset class. Why? Because of the leverage, the debt pay down by the tenant. I have people that are, and I want you to speak to that have them, and then they want to pour their profits into paying down the mortgage. Whereas I said, look, you should save it, use your equity, and go get another house. You want to, because the way I just heard you say, you need to get into more debt.
Oh yeah, good debt. Now more debt that's good debt, right? So
More
good
good
debt to
debt.
me,
Yeah, good debt.
it's generating net cash into your pocket. So by taking out debt that generates more income to you, essentially the more the better. But it's got to generate positive cash flow to you immediately, not be a hope on some future cash flow.
Right. So you don't buy for appreciation. It needs to cash flow from day one. Right. Okay. And so as you make money, folks, when you buy real estate, appreciation is a bonus. And so that is awesome. So Jim, tell me, I want you to talk about this for a second. So you and Tom, you heard my podcast on Kim's show, right? And you told me you
Yeah,
had a really interesting conversation with your daughter. Who does your books? I want to talk about that for a second. About my talk about cash flow management, but you have is she 12 now?
she's 11. Yeah,
11, and she does some of your books for your multi-million-dollar real estate company?
Well, what she does is so we do a financial forecast, kind of like a very simple income statement where we show the revenue from residents paying us rent, and then we take away the expenses for a property, like property taxes and insurance and maintenance and things that you would normally have, utility costs, etc. And you come up with a net profit number, and from that net profit, you've got in our model, you've got to pay the mortgage payment afterwards. And after you pay the mortgage payment, whatever's left over is your cash flow. And so we will typically project out 4 or 5 years when we buy an apartment asset. And when we underwrite those, we give them to my daughter, and she goes back through them and adds them up and verifies them. And sometimes she finds a couple dollar typo here or there. And she's been doing that since she's probably 8 years old. And
Wow.
she's
I
just
love
our
that.
checks and balance.
I love that. My middle child is 14, so I was like, all right, Jade, we gotta I'm gonna I told her your story, right? I says you're behind, so we gotta get you on these books.
Yeah, I
So
got to plan cash flow for kids, Curtis. That's how it's cash flow for kids is a great way to teach them income statements and balance sheets, and for them just to absorb all of this stuff that really you're never taught in school. You're not taught by anybody else, and unless you're really curious to go learn on your own, you really don't know how to become wealthy. And maybe that's a on purpose structure for the historically wealthy in our society, but it's not really well known unless you go out and seek it.
yes, yes. What are other types of things you do along that line? In terms of how you talk about it, how you teach kids about it. You do have anything else that you think is relevant, interesting that other families could duplicate?
I mean, we try to just teach our kids about um, you know finances and resources, and certainly we want to teach them good values and have good character. But when we go on a vacation, we just don't go on a vacation. We'll my wife and I will tie a vacation to the fact that we bought a building, and that building's really profitable. And because we bought that building, we'll show the kids the pictures of it if it's not local that we can drive by it. We'll explain by buying that building, we got cash flow, and that cash flow is paying for our vacation. So now we can go on a trip, and they realize it's because we're investing in cash flow. They get to do fun and exciting things.
I love that. Like money is just not coming from this magic ATM machine. Well, just go to the ATM machine. And they're like, look, no, we've got to do stuff so that money's in there to get back out. And somehow there's a disconnect. Or can I just take an Uber? I was like, my kids are like, oh, I'll just take an Uber. Okay. You know, Uber's tied to your mom's credit card, and we have to make stuff happen for that to happen. This is just not some, thing we let you put on your app for emergencies. Because my kids will take an Uber and then well, I'm just gonna, have my friends come over and I'm just gonna send an Uber for them. I was like, hello, no, 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 you don't have it like that. So, and if we did, you wouldn't have it like that, because look, their parents either have their own Uber account, so that's funny. And so we're going. I've played cash flow, and it's funny because I like cash flow, and I actually like Laurel Langmeyer has a game called The Millionaire Maker. So I'm playing with, both of those, and I want to create a monthly like client for my local clients where we get together and play it. And then what I want is like in the cash flow game, one of the systems he says, look, get 5 people and y'all should play at least once or twice a month, and then get together and take notes about what you're doing in the real world. Uh, yeah, and so, my goal is to grow our clients. Like we teach a 4-step process. I was thinking about your process. We call money for life, which is, freedom from debt to others. We use it in the banking process, using the life insurance. We want you to have ready cash when you need it for emergencies and opportunities to invest. Passive income you don't have to work for and you can't outlive. So you kind of laid out I talk to people about different asset classes. Pick an asset class you like, but I think this, is brilliant. Just taking this, whether you're an active investor, you want to do it yourself, or for you all busy people who qualify, I want Jim to start talking about, Sante and your offering. He is one of our partners, so that I source for, that want to do this stuff. Here is this company, and I want you to hear that you're not just like giving money. These guys have a way to do business, and they make their partners money. right? And so you have to, and the fourth thing is developing a legacy of wealth and wisdom. And see, so the stories that you just talked about is part of, part four, which is the legacy. We call those the four pillars of a strong personal economy. So I always tell people, when I sit down with you, that is the end of the movie. And then we just need to get a process to get you from point A to point B. So, Jim, so give me, maybe two books this is really more so for me than them, that you're reading that I don't know that I should be reading right now, that you're that you like, that maybe last year or you're reading now currently.
Well, I'm not sure you don't know them, Curtis, because I know you're an avid learner. But our business I'm not just a real estate investor, but we have a business, so I read a lot of business books.
Mm-hmm.
So one I really like recently was Extreme Ownership. Not sure if you heard of that, but that's a great book. Some gentlemen that were Navy SEALs wrote a book about extreme ownership, and they apply their Navy SEALs training to business.
Okay.
So that was really insightful, and our team is enjoying reading that and learning it as well. And so that's been good. And then one I always go to is The Great Game of Business by Jack Stack. It's not a newer book, but The Great Game of Business talks a lot about metrics and gamification and a lot of things for entrepreneurs. And so those are a couple of my top ones off the top of my head, but there are a ton. I listen to more books on Audible now than read physically, because I can listen to Audible anywhere. So that's the way I digest them.
Yeah, well, Audible counts. I mean, that's what I do. I still read a lot, but my Audible app is my favorite app on the phone. That and my podcast player.
Mm-hmm.
And
nice.
So that is fantastic. So Jim, how can if my listeners want to know a little more about Sante and some of the things, now let me back up. So your offerings are for accredited investors, right? Okay.
Correct. We only provide investment opportunities for accredited investors, which is an SEC term that people have to have certain income or certain net worth to qualify to be able to invest with us in our cash flowing real estate.
Okay. And so if you're not sure, you can reach out to me or to them, and we can let you know. But if they, you mentioned you had a book, and I know you've got stuff on YouTube and you got a website. So if they want to find out more about you guys and what you got going on, what's the best thing for them to do?
Yeah, I think that the easiest thing is just to go to our website, which is santerealty.com. I think you put it in the notes, but it's SANTE and then the word realty, REALTY.com. There's a nice draw shop video that kind of explains our philosophy of real estate investing, and I think that could be helpful for anybody who likes this asset class.
Awesome. So we'll definitely put that in the show notes. And listen, Jim, I want to thank you for your time. We're at about a little over 30 minutes, so I appreciate you. What I want to do,
it was really enjoyable, Curtis. Thank you.
Yeah, it was a pleasure. I thank you so much for that, and I hope you guys got a lot out of this, because you need to listen to this more than once, because he gave you some serious nuggets in there. I'll probably recap this on an intro video, so that I can make sure people are listening. Sometimes you got to help people listen right. They don't listen; they miss the good stuff. And but I'm excited for y'all to hear this as I speak. We just finished our Eagles parade. I probably date this to keep it evergreen, but I'm excited because my Eagles won the Super Bowl. So Jim, I want to thank you and for being on the Practical Wealth Show.
It was great. I really appreciate it. And I was learning from you, Curtis. So thank you for your sharing knowledge and information always. I love listening to your podcast. So thank you.
All right. My pleasure. And so, guys, keep listening, keep sharing. And I hope you enjoyed the show. Y'all have a wonderful day. And this is Curtis and Jim, and we're out.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted before syndication or rebroadcasting.